All right, Code 3 Americans, welcome to the May 2023 Code 3 American Investor Meetup. Got some good information tonight. I think it'll be timely with everything going on in the banking system. I think anybody that's watching any bit of financial news has certainly seen a little bit of chaos going on there. So tonight we're going to do the best we can to kind of explain a little bit about money and banking, what most people don't know. A lot of people have some pretty significant misunderstandings of that. And Brian, you should be able to see a screen with American flag on it, yeah? All right. A little bit of housekeeping. No recording in any form without our consent. It'd take written permission, and we haven't given any of that out, so please don't record. We do not give tax or legal advice. Please check with your tax and legal professional, as we do not provide tax or legal advice, and above is not intended to or should be construed as such advice. Your specific circumstances may and likely will vary. This is not an offer or solicitation. I know a lot of people on the call know that we do private placement investments. That's not the purpose of this meetup. This presentation is for informational purposes only. This presentation is not intended to be a securities offering of any kind. Prior to making any decision to contribute capital, all investors must review and execute all private offering documents, including the private placement memorandum and its exhibits, which contain complete information about the investment opportunity. The information contained herein is from sources believed to be reliable. No representation by us is expressed or implied as to made to the accuracy of any information herein. All investors should, as is in anything, should conduct your own research to determine the accuracy of any statements made. Hopefully, if you're doing any investing at all, you're doing your due diligence. So nothing new there. Normally, I'd spend a little time talking about our mission statement. What we're doing is the Code 3 American Investor Meetups, but it's not just about investing. I know a lot of you know that mission that's been on here before. I'll show you a way at the end that you can get a book. It's got a chapter and it'll explain that, save a little time here. So agenda for tonight, we're going to talk about how banks and money work. That's grossly misunderstood by most people, including myself, forever. And once I understood that, the light bulb really went on, and all of a sudden you could see opportunities and kind of read the tea leaves, if you will. We'll talk about bonds and interest rates. Those are critical to what's going on. Banks and commercial real estate, some exposure there, and some other kind of signals that we're seeing in the markets, and maybe some things we can do. No sense in coming up with a way to say something that's already been said well, so I'll just steal from George Gammon. There are no certainties, only probabilities. So always be cautious as somebody, I think, that tells you what's going to happen, because the truth is nobody knows what's going to happen. But if you start to understand the fundamentals and the plumbing inside the system, you can kind of start to read what's going on and have a better understanding of what's probable. All right, so with banks, the biggest misconception people have, and I think this is important, it's very timely right now, is they think when they take their money to the bank or they deposit a check in the bank, their local bank, that their money's somehow hidden inside this vault inside that bank. So if you put $100,000 in the bank, you just assume there's $100,000 in that bank for you to go stake a claim on and get out of the bank at any time. Nothing could be further from the truth. And I think that's something that's very widely misunderstood. And I think if more people grasped what really happens with banking, they would be able to better make decisions for themselves to either avoid problems or capitalize on opportunities. But again, that's the biggest misunderstanding, I think, as just having this conversation the other day, is people think that the money's in the bank, and once they go get it, they could just get all their money out in cash. Well, there is certainly not enough cash in the bank for everybody to do that. So something we got to understand is banks, the bank account balances that we all have, is just a very complex series of interconnected ledgers. Think of them like a scorecard. I heard George Gammon say that, instead of saying what's your bank account balance, you could say, what's your score? What's my score? It's something that we all agree upon. When I say we, the system agrees, and the balance sheets balance at the end of every day, but they're just digital. They're the most money in circulation, and I use the term money loosely. When I use money, I'm using it interchangeable with you're going to hear me talk through here, but bank reserves and cash and treasuries and all of those things. But they're mostly just digital entries in a computer system that are tracked in in ledgers, and they're all interconnected. So it's all based on, we all trust the ledger system, the accounting system, and that's what money is. It's digital. And that ties into a whole nother thing with central bank digital currencies, but we'll see if we have time for that at the end, maybe a little Q&A. But just understand that the money is just digital. So this is where you're definitely going to want to start to pay attention. Your asset, your deposit, is the bank's liability. When we put money in the bank, we are loaning them our money. Okay, that's an expense to them because they're paying us interest. So they're using that money and they're loaning it out. Assumably, they're loaning that money out to other people at an arbitrage. In other words, if they pay you 1% and loan it out at 5%, they make 4% less their expenses. So that's pretty obvious. But a lot of people think that money is in the bank, and it's not. And I'm going to explain the way money is created because that's misunderstood. And we're going to talk about how money moves back and forth as we pay each other and transact within the economy. So I just want you to understand that on this sheet, for example, any place you see, because we're going to look at these T charts in the next several slides, really important we grasp this. There's going to be a legend on each sheet, and I color coded them that'll correspond to the colors down on these balance sheets and so forth. Liabilities for the bank, based on what I just said, our deposits are their liabilities. So these are the bank's balance sheet. Liabilities are deposits. Okay, so think about if you see liability here and we're talking about your bank account for the scenario, just think about that as your deposit. Then they have to have an offsetting asset to that liability, and that's going to be bank reserves. And we're going to talk about what that is. But they're basically just currency units, if you will, that the Federal Reserve creates. They're responsible for creating them, and it's just digital money. If you can, now you and I can't have bank reserves. Only people that have accounts with the Federal Reserve, so major banks and some institutions, Treasury General account, which is Janet Yellen, you know, the government's checkbook. There's a certain number of entities that can have accounts with the Federal Reserve, and they transact all in bank reserves. We transact in digital deposits or cash or things such as that, Treasury bills and so forth. So in each slide, you're going to see assets and liabilities. So here, if this is our bank, if we bank at Wells Fargo would have $100,000 worth of bank reserves, and we would have $100,000 worth of deposit credit, assuming we were the only person banking there. We're not going to talk about how the bank took seed money and got started up. I started kind of boiling this down to something simple enough we could all understand it without getting too deep. So it's kind of a simplified version, but very accurate. So just understand, let's say you're the only depositor at Wells Fargo. There's $100,000 in bank reserves, their asset, and $100,000 worth of liabilities, okay, your deposit. So their liability is your asset. Now, total money here, if we have another bank, them, whoever that is, so this is you and this is the other person in society, they also have $100,000 in bank reserves at their bank, offset by $100,000 deposit. So this person has a $100,000 deposit, and you have a $100,000 deposit. Okay, and each bank has $100,000 in bank reserves. Total money in the system right here is $200,000. And I want you to watch this as we go through these slides. This is the number we're going to see changing. We'll see these so these numbers represent the money in each bank, currency units, and this represents the currency units in all of our fictitious economy. So now that we understand that, let's talk about, oops, that might have got messed around. Let's talk about how money is created. Money is loaned into existence, okay? So most money, I should say, not all money, most money is loaned into existence. So let's say, again, before we just had $100,000 over here at Wells Fargo, and let's say this is you, and you're a contractor, you build houses. You go down to the bank and you want to get a loan to build a garage or something. You get a $90,000 construction loan. They vet you. They're comfortable that you'll repay the loan. There's some due diligence on their part. Maybe you got to pledge some collateral. What happens if they don't get paid? They go through a process, but assuming they want to do business with you, they think you'll pay them back. They'll loan you $90,000. When they do that, they just type in $90,000 of deposits into your bank account. That's right here. They just type it into a computer. It just appears. And it's offset by a $90,000 loan. Okay, that's their asset, and the deposit is their liability. Now, this person over here, this is them. This is going to be a subcontractor or something. Nothing's changed over here. Nobody's done anything. But notice the first slide, we had $200,000 in our fake economy. Now we have $290,000 in our fake economy. So that's how most money is created in our system, is through bank credit, bank loans. Now, let's say, this is where it's going to start to get a little complex. Let's say you, the contractor at Wells Fargo, you had that $90,000 loan. So here's the loan offset by the liability they put in the bank. Now, and I actually labeled this wrong, but now you're going to pay $70,000 to this subcontractor. So you write a check, $70,000 of digital money gets sent over to this person's bank. They put $70,000 of deposits, the bank's liability. They transfer those deposits to the bank. Well, since they transferred the liability, they also have to transfer the offsetting asset. So they send $70,000 in bank reserves over to the subcontractor's bank as well. And I should have, instead of crossing out this 100, that was the original funds, I should have just drew it down over here. But either way, it's the same thing. You'll notice their assets, we originally had $190,000 worth of total money in Wells Fargo. It's now $120,000 because we sent 70 out. The other bank increased from 100 to 170, and our total money in our fake economy went to $290,000. It's still the same. See, before it was 290, it's 290 now. All we did was send digital assets, deposits and offsetting assets to the other bank. That it doesn't matter if you pay by debit card, check, or how that works. That's how it goes. I thought about putting cash. In fact, I did have cash put into this, and I just realized this was going to get far too complex for everybody to grasp tonight. So I took cash out for the purposes of this. But just understand, this is how money moves from bank to bank in our system. And we're talking all domestic banks here. We're not going to do anything international tonight. So again, the banks create money. Now we're over at this other bank. They've taken in more money. Originally, they had $100,000. Then they got the 70 because they got paid via the subcontractor. So now they're at $170,000 worth of assets. And the subcontractor decides they want to do business. They want a construction loan, or maybe they want a car loan or a house loan, or whatever the case may be. They want a loan. And the bank decides they're creditworthy. Poof. Again, they type a $100,000 deposit into their bank account, offset it with a $100,000 loan. Okay, so the loan is the asset, and they just type those numbers into the bank account for your deposits, and the money supply increases to $270,000 in this bank, and our total fake economy went to $390,000. So think about what we started with. We started with $200,000, and by making two loans, we originally made a loan on the Wells Fargo side, and then we made a loan on the subcontractor side. We made a loan of $90,000 here and $100,000 here. So we grew the money supply in the economy to $390,000, up from $200,000 where we started. So that's the first thing people got to understand, and it's critical for the time we're going into, I believe. The most money, not all money, but most money is loaned into existence via commercial banks. However, what did I say? I said the banks would make these loans if they felt comfortable that you are a worthy creditor. So they're going to have to feel comfortable with you. They're going to have to feel comfortable with your project, and they're going to have to feel comfortable with the environment. And that's where this is going to become important. So let's say we got the same exact thing. I'm just showing how the money moves one more time. It's really no different than a couple slides ago. Now the subcontractor is going to pay $50,000 back out to this guy, you, at Wells Fargo. They just, all this bank does is send $50,000 worth of deposits. That's what I'm crossing out here. There was 70 here. Now there's 20. They send $50,000 worth of deposits out, digital money, to Wells Fargo. Well, since they sent the deposit, which is a liability, they also have to send an offsetting asset so the balance sheet balances. So they also send $50,000 in bank reserves over to Wells Fargo. Their total money supply goes up. This bank goes down. Aggregate total in the system stays the same at $390,000. Nothing changed. The money just moved from point A to point B, and then point B back to point A. Okay, everybody got that? So how do banks reduce the money supply? If they're increasing money supply via loans, how do they reduce it? Well, simple. they let loans get paid off faster than they're re-originating loans. So if all of a sudden this $100,000 loan gets paid off that this subcontractor's bank had, and they don't initiate another loan, the money supply shrinks. In the system, it goes from 390,000 to 290,000. Now that's a little bit, Brian's probably over there kind of grinding his teeth. That's a little bit misleading, because the money supply has always got to be a little bit more, because you got to pay interest. So I don't want to get into that. So it's always going to be a little bit more than the principal, but that's going to get a little complex, I think, for what we're trying to accomplish tonight. But just understand, loans get paid off, money supply shrinks, loans get made, money supply grows. Every day loans are getting made and loans are getting paid off. So you can have a lot of that happen over periods of time and have slow inflationary pressures, because there's always got to be a little bit more to pay back with interest. And that gets, like I said, kind of complex. So a few types of money, without getting into, we're not talking all of what would be called M2 money supply. We're not getting into, things that can be easily liquidated. We're talking actually forms of cash or cash equivalents. So the first thing is, when people think, remember how I said a lot of people think that cash is sitting inside the vault at the bank and that's where all the money is. Again, that couldn't be further from the truth. And you can see that here. If there's about, these numbers are a little bit old, but not that old. If there's about $45.7 trillion in currency units, only 2.3 trillion, or what we call fiat currency or cash, the $100 bills in your pocket. Very small percentage, about 5% in the entire system. Then there's about $3.3 trillion worth of bank reserves. Remember, those are the digital dollars, if you will, that the Federal Reserve creates, that only people that have banking accounts with them can have. We don't deal in that, but there's about 3.3 trillion. This illustrates my point. About $17.2 trillion worth of bank deposits. This supports what I just told you. If you add these two together, it's way less than 17.2 trillion. Okay, this is because most money is loaned into existence via commercial banks. And what I'm showing here is just that the bank deposits have went down since last year. So then we get into U.S. Treasuries, the cash equivalent, because you got to understand that a lot of people, if you're an institution that's got millions of dollars, you wouldn't want to keep all your money in the bank, because it's only insured to 250,000. Well, based on what's been going on in the news, people should have a grasp of what happens there. You could lose your deposits. I actually know somebody that his sister has works at a big company, and in Silicon Valley Bank, when that happened, one account that company had $32 million in it. Okay, and it's only insured to 250. Boy, were they happy when the Fed showed up and saved them. But what those folks often do is they'll put their money in money market funds, or they'll buy treasuries. So there's about $22.9 trillion worth of treasuries out there. So this is a cash equivalent, a place to store your money outside the bank accounts if you have uninsured deposits. And there's various other reasons you'd want that. But I just wanted to show the different tiers of money. And then this is where it's going to get a little bit complex, perhaps, in these next couple slides. So let's introduce the Treasury Department. I'm not going to overlay this with the Federal Reserve and talk about who manages their bank account and all that. I'm trying to keep this as simple as possible. The end result is what matters more so than every mechanical piece in the transaction. But let's say Janet Yellen wants to government deficit spend, which has happened every year since, I think, 2001. The government has spent more than we've brought in income. So let's say they want to create $100,000 worth of treasuries, T-bills, 10-year bonds, whatever it is. It's just a debt. A bond is just an IOU. They're creating a promise to pay the citizens back, or whoever buys it, and then they get to spend that money to pay government bills. So let's say they sell $100,000 worth of treasury bills, and they sell them to a bank, or they sell them to a banking entity. Well, what would happen is they would just transfer those T-bills over to the asset side of, say, Wells Fargo. This is if we're dealing with a bank, not a non-bank entity like a person or a primary dealer. We're talking about banks. They would transfer the T-bills to the asset side of the bank's balance sheet, and the bank would simply transfer back $100,000 in bank reserves to pay for the T-bills. Nothing changed with the money supply in the system. See? There's still $100,000 in this bank, and there's still $100,000 in the system. Hopefully that makes sense. So nothing changed there. We didn't really print money. We didn't increase just in this step alone is what I'm illustrating. That's why I circled today, not if all this money gets spent out into the economy and starts taking high velocity positions. I'm talking about today when the trade happened. It looks like we've printed money, but we haven't. All we did was trade assets. Okay, trade assets and liabilities essentially. So I just wanted to illustrate that when the Treasury Department goes through all the mechanical pieces it would go through, but at the end of the day, they give the T-bills to a bank and the bank pays for it with a bank reserve. The money supply didn't change at that point. Now, this one might make you a little dizzy. I wanted to block this off just so we had a reference of what that was last time. We're not really going to talk about the Treasury Department here. Okay, but now let's talk about that. Let's say the $100,000 in T-bills, that's a liability to the Treasury Department. Now you ask, what is the offsetting asset? Your future taxes. Okay, they're putting a claim on your future tax revenue of that $100,000. Okay, so what I really wanted to get across here is the Federal Reserve's the only bank that can't go bust. So let's say they're going to do quantitative easing. They're going to inject liquidity into the market. How they do that is they're going to buy an asset. It could be, in this case, it's going to be a T-bill, but it could be a mortgage-backed security. It could be a number of things. But here, they're going to buy it from you, a citizen, or they're going to buy it from a non-bank entity, a primary dealer. Now, if they bought it from you, they would have to go through a dealer. But nonetheless, the money ultimately ends up off the bank's balance sheet and onto some non-bank entity's balance sheet. You'll see what it does. So what they do, this is the original bank reserves that the Fed had from the previous slides. Remember, Janet Yellen, if we go back, had sold those T-bills to Wells Fargo. Now, they're going to go through a dealer, but let's not get too lost in the mechanics. Ultimately, at the end, the Federal Reserve wants to do quantitative easing and buy these T-bills from the non-bank entity. Now, they're going to go through a process again that I have not illustrated here, but just understand the end result is these T-bills are going to go over to the asset side of the Federal Reserve. And the Federal Reserve, to pay for those T-bills, is going to send $100,000 in bank reserves to Wells Fargo. Okay. They're going to tell Wells Fargo if Brian bought the T-bills to go ahead and credit his account with $200,000 worth of bank deposits, which is a liability. What just happened here is we just grew the money supply by that $100,000. Okay, there doesn't have to be anything offsetting over here. They just simply created it. That is how the stimulus payments were paid for. And when all of a sudden you see the federal government spending trillions of dollars on just a drop of a hat, they didn't collect that in tax revenue. When you hear printing money, they're not actually printing it off of printing presses in $100 bills, because we already illustrated that there's only less than about 5% real currency bills in the real economy as far as the currency units circulating. So what they actually do when they print money, they just digitally create it. They buy an asset out of the primary sector, or I'm sorry, out of the economy, excuse me, through a primary dealer, and they just credit that with bank reserves back to those people, whoever that is. Now, all of a sudden, that money's out in the real economy, and it can be used to purchase things. It has velocity. It could be used to purchase cars, televisions, houses, whatever the case may be. So they do this all the time. This is quantitative easing. They're actually buying the assets out, which are treasuries, mortgage-backed securities, and so forth, and they're injecting more bank reserves and then deposits directly into the system. Okay, so when you think about where this can become very inflationary is, without going down a whole nother rabbit hole, we've done other videos on this, but what happened during the illness is this money just got dropped all over America and went to consumers. Well, when consumers all of a sudden have a big bank account balance that just popped up out of nowhere, and they don't have a liability they're responsible for to pay for it, or to service, excuse me, they just start spending money. So at a time that we had no supply, no stuff, we had a lack of stuff, all of a sudden we also had too much money, and surprise, surprise, you get consumer price inflation. But the inverse is also true. Think back to 2008, when the banks were all in trouble. This was done, a tremendous amount of this was done but the money never ended up out at the people. That's more like this slide. Instead of this being the Treasury Department, they did it through the Federal Reserve, and they just started putting liquidity on the bank's balance sheets, and that ultimately led to, after some years, inflationary effects in stock prices and so forth. Because when banks end up with a bunch of extra money, they tend to get involved in financial instruments. They're not out buying big screen televisions. So where the money goes, wherever that money gets spent into, whether it goes to the Treasury and then they spend it directly into some sort of project, that's usually the place you're going to see the inflation, is wherever it gets spent first. So if it goes into the financial system, you're going to see financial asset inflation probably. If it goes into the average Joe and Jane on Main Street, you're going to see television prices go up and used cars. So you kind of got to understand the way this flows, because once you do, first of all, you know more than probably 90% of the population, and you can start to read the tea leaves. You can see what they're doing, and you start to expect what the end result or the end effect of that will be. So we're going to move on. Hopefully everybody grasps that. I know that's kind of a lot. So just like anything else, there's supply and demand with money. And most money is debt. I illustrated that. So only a small portion of the money circulating in the real economy is real paper money. Most money is loaned into existence. So what happens when massive debt goes bad? So you guys might be wondering, why do I need to know all this? All I do is pay at one bank and get the money at another bank. Well, you want to know this because you're going to see the cause and effect relationships of everything that's been going on the news, or maybe what ingredients, I should say, or at least in the punch bowl, causing those problems. So when debt goes bad, the money supply shrinks because loans are paid off at a faster rate than loans are created, because it's based on trust. Okay, so the banks, if they're scared and everything's falling, they're not going to loan money. And that's where people are kind of mistaken when they're saying, oh, everything's about to turn here and interest rates are going to fall, and then I'm going to go buy whatever I'm going to buy. You might be surprised, because you might go talk to your banker and they say, no, we're not going to give you any money. Okay, because they're scared to death. So just because interest rates fall doesn't mean there's going to be a slew of buying opportunities for most people, because the banks are going to be tight. Okay, they're taking a beating right now, and it's going to take a while for the black eye to heal. So assuming the government does not interject liquidity, because obviously during COVID, they dropped tremendous amounts of it. So who knows what they will do. But assuming they don't drop liquidity, how fast will the money supply shrink when large portions of debt suddenly go bad or are not renewed? So in addition to traditional bank loans, remember, bank deposits are also loans. You're loaning the bank money. As money starts to go bad, how much are you going to loan the banks if you don't trust them? Just like how much are the banks going to loan you if they don't trust you? Okay. So then you got to ask, in a closed loop economy, is the currency units, this is what I'm getting to with supply and demand, is the currency units are circulating in the economy, they're all competing for goods and services. Well, if those currency units shrink, there's less currency units competing for the same goods and services that were there yesterday. That means either there has to be less stuff or less services. That's how you get to unemployment. That's how the Fed essentially gets the employment rate to drop, is when banks quit lending and they start killing off money supply through, or debt starts to go bad and the money supply starts to shrink. There's less currency units out there competing for that same number of people. So either everybody has to take a pay cut, or a few people got to lose their job. So that's one thing that can tie into the unemployment. The other thing we got to grasp is that when bond yields rise, values fall. And I'm going to explain that. So when you think of bonds for the purposes of this, think treasuries. And then we got to think, what effect does that have on their balance sheet and their ability to lend or borrow? So just keep that in mind as we go forward here. I want to show you, this is the Fed funds rate. Little bit of fake news, because the Fed funds rate, everybody looks at the Fed funds rate. They just raised it a quarter point yesterday, I believe. That is not directly tied to all the other interest rates, mortgages and auto loans and so forth. Now they have a direct effect on how the other instruments perform that ultimately set those prices, but it's not just an absolute they're not absolutely tethered together. But I want you to look back at a period of time. We'll all remember the great financial crisis. And what I'm saying is the rate of change matters greatly, more so than just the amount of change. So when people are looking, oh, interest rates been 5-6%, no big deal. I've seen them 10%. Some people that are old enough, I've seen them 18%. Well, Okay, but we got to look at the rate of change. So here, back leading up to the GFC, interest rates were 1% and went to 5.25. So it went up 5.25 times in 2 years. Went up 5 times in 2 years. Here, interest rates, the Fed funds rate was 0.08. That's 0.08. And just the other day, it was at 4.83 before they raised it. That's a 60x increase in 14 months. Huge difference between this 5% and this almost 5%. Huge difference. Okay. So that's important. So then here we go to the 10-year treasury. There's a correlated effect with the 10-year treasuries and mortgages. So that's why I wanted to bring this up. And a lot of banks have various bonds on their balance sheets. So I wanted to kind of give some scope. In August of 2020, the 10-year treasury is about 0.5%, 0.55. In October of 22, so 26 months later, it's up 7.5 times. Again, rate of change more impactful than amount of change. So you're going to see that as we go forward, why that's so important. So we talked about bond yields rise, or I'm sorry, bond values fall as the yields rise. Here's why. Let's say, just focus up here in the upper left. Let's say you had this old bond, say you were a bank and you bought a $1,000 bond, and I'm just trying to keep this simple, paid 2% yield. That's $20 a year. So this thing's going to kick you off $20 a year. So you're holding it. And if you hold it to maturity, nobody cares. Okay, it'll be worth $1,000. It'll pay you the $20 a year. Nobody cares. That's how most retail investors view bonds, is they think, well, what's it matter what the bond values do if I'm just holding on to it as a savings instrument? Well, then you don't care. However, we just talked about a lot of institutions hold their assets. Remember on the bank's balance sheets, a lot of it isn't just bank reserves and so forth. It's bonds. They hold a lot of assets in bonds. A lot of institutions that aren't banking entities, but hedge funds and so forth, they hold bonds as assets because they don't want to put $5 billion in Wells Fargo or Silicon Valley Bank because of what just happened. So they hold it in treasuries. It's a cash equivalent outside the banking system. So understand this is your old bond. Now you change environment, because we just talked about rates shot up. So now we're in a new environment. And I know this isn't the same, but it's just an example. Keep the math simple. New bonds are being issued, and now they pay 4%. So they're going to pay you $40 a year on your $1,000 bond. Well, if you're somebody that we just described that holds these bonds and you're not going to hold it to maturity, you might have to sell it, okay, to get liquidity. How hard is it going to be to sell this bond? Who wants to buy this bond that pays them $20 a year when they could just go get a brand new one that pays them $40 a year? Nobody. So what has to happen? Your bond has to be marked down to current market value. And the way you get 4% out of this bond is you sell it for $500, because at the end of the day, the bond's only going to kick off 2%, right? So that's fixed when you get it. Well, the way you get 2% to turn into 4% is you pay less for it, because you got to be competitive with new bonds in the market. So what happens, you have to mark down the value of the bond, and you might have to sell that for $500, say, to get the same 4% yield that new bonds are producing. That's why when interest rates go up, bond values fall. And that's really, really critical with what's going on right now. So, and now I'm going to go into commercial real estate loans. This all ties to bank balance sheets. So I just put this out in the newsletter. If you got our newsletter here a few weeks ago, this is the example that was in here. And this is before I seen the news article I'll mention in a minute. But I gave an example because there's about $1.5 trillion worth of commercial real estate loans coming due in the next couple years. Because you got to remember, a commercial real estate loan is not like buying your house. Okay, you may get a 30-year amortized loan, meaning the payments are structured as a 30-year loan, but it's got a balloon, which means that that loan may come due in, whatever, 3, 5, 10 years, whatever it is. They all got different terms, but 5 isn't that uncommon. So I picked a 5-year loan. I said, let's say that loan was originated before the illness in 2019. And let's say everybody was feeling frothy back then. The market was looking good. Assets are valued based on the cap rate and their net operating income. I don't want to leave anybody behind, so let me explain what that means. Net operating income is the rent minus expenses, but does not count debt. Okay, it's before debt. It's revenue minus expenses before debt. The cap rate is kind of whatever that market is willing to pay for those assets, what rate of return they're expecting to get out of that asset. So a 5.5% cap rate on a $10 million building would be a $550,000 NOI. Well, the inverse is also true. You get to the NOI, you see what the area cap rate is. This is, in other words, this is what investors are willing to accept on that particular asset class. If it's really booming and going hot, I mean, multifamily got all the way down to like 3%. They're saying, hey, this is such a good asset. We'll take it at 3%. If the asset isn't very good, they may say we want 8%. The higher the cap rate, the lower the value of the asset. Okay. So the way you figure out the asset values, you find out the net operating income, you divide it by the going cap rate, and that's the asset value. So a $10 million asset value back then in 2019, let's say the bank was feeling frothy and they loaned you 80% loan to value. They're going to give you an $8 million loan. Interest rates were about 4% then. And investors would have to bring $2 million in equity. Now that loan balance is going to come due in 2024 at $7.24 million about. Well, let's look at that in the environment now. Vacancies, we're talking office space. Office space is getting hammered right now, and it has been for a few years because the work from home issue. And people fleeing these frankly terribly ran cities, and they're dealing with the fallout of that now. Everybody, there's like 500 people a day moving to the DFW area. They're coming from somewhere. They're not all being born. They're not all being born and just suddenly adults. So they're leaving somewhere. So whatever they're gaining in Dallas, they're losing somewhere else. So these vacancies are increasing in a lot of these areas that were prime at that time. So let's say vacancies increase 7%. So let's say we planned on a 10% vacancy. Now we're seeing 17. They increase 7%. That reduces the net operating income because we have less revenue from rent. So now if we just drop our original NOI by 7%, we're at $519,000 in net operating income. Well, cap rates also rise when people are less certain. Nobody wants a building that is falling out of favor and people are fleeing. So they're saying, no, I'm not willing to take a 5.5% return anymore. Investors, the aggregate total of their opinion is they say we require 7% maybe for this example. Well, now you take a reduced net operating income and divide it by a higher cap rate, and your asset is worth $7.4 million. Problem. You owe $7.24 million. This is before closing costs and all that stuff. Now, that's assuming, let's say the lender still allows 80% loan to value. In other words, they're confident in you, the market, and the asset. Or as Robert Helms would say, they're confident in the track, the jockey, and the horse. Okay, they would loan you $5.93 million. You could see an immediate problem here. Not enough money. So now you're going to the investors saying, hey, we need more money. Ooh, that's going to be a tough sell in times like this. But what if the lender isn't feeling safe, like they're not, and people like Kenny McElroy will tell you they're already seeing 50 and 60% loan to values, and now they're only going to loan you $4.5 million on that 7.24 that's due. Or maybe 50%, they only want to give you $3.7 million on the 7.24 that's due. Pretty soon, the keys go back to the bank. The banks don't want to hold them, so that they go into a fire sale, okay? How much money just got destroyed? Remember, we just talked about how money was created. It's through lending of money. So not only did we destroy the loans, and we replaced a loan that was originally $8 million with a loan for $3 million, but all this investor equity is also gone. Okay. That is deflationary by nature. Currency units just died. That's how now, so you start to have monetary deflation that bleeds into economic deflation and in a sluggish economy or a recession. Okay. So back to office space. Wall Street Journal, this is in San Francisco. This came out after I did that newsletter. $300 million building in 2019. It's so vacant. They were at auction, and I don't know what it settled at, but it was at auction. They were expecting about 60 million out of it. Major problem. How deflationary is that? And then what kind of contagion is that? What does all that connect to? We talked about the interconnectedness of all those balance sheets. There's a lot of all that stuff becomes it can kind of spread like wildfire, if you will. So then you look at cell phone data in percent of 2019 activity. This is 2022 as a percent of 2019 activity. Look at San Francisco, 31% cell phone data in downtown San Francisco is what they had in 2019. That's a clue. Okay. I just flew home from Texas. I was visiting with a real estate investor from Denver. She said the downtown district's a ghost town. Nobody's around. Well, what are we seeing right here? 59% cell phone activity comparative to 2019. This is why this is just another piece of anecdotal information that reinforces the office vacancy problem. Okay. And all of those buildings are on somebody's balance sheet as an asset supporting a loan, a liability. Okay. When they start to die, that's deflationary on the monetary side. Here's another I wanted to show you a real world example, not something hypothetical. I've been watching this deal since 2022, July. It's an apartment. It's new construction. It's about 90 units, I think, with some garages. Using their numbers, they originally priced this building at $20 million. I called him, told him, I tried to talk to him, said, oh, no, that's nuts. Well, they dropped it to 18.5 a lot of months ago. I think it was late last fall. I had another conversation with them. They wanted to know what I thought. I said, well, I really just kind of back of the napkin math. I hadn't really thought about it or looked at their numbers, but somewhere between 13 and 15.5 million. And I remember he said it just like this. The broker that represents the developer, he said, well, that can't be. He's got more money in it than that. And I said, well, I understand your position, but what he has in it and what it's worth are not the same conversation. Okay. So this is what they underwrote. This is their numbers: 119,682 in monthly revenue, 1.4 million in annual revenue. That's rents. They projected 0 vacancy. Oops. 23.4% total expenses. A good buddy of mine's got several hundred. He's done several $100 million worth of real estate deals, owns a lot of these things. He says no bank will even consider on new construction less than 32% expense. Oops. Cap rate at 6%. People are more nervous now. And they got a sale price. If you take their net operating income, take the expense out and divide it by a 6% cap rate, that's how they get to the $18.5 million. That's what they're trying to sell it for. Let's take a look at a little reality check here. Using their numbers, assuming their rent numbers are completely accurate. Okay, not even pricing in an unstable economy. Same monthly revenue, same annual. Throw a 10% vacancy on it, pretty standard. I've actually looked at that market. It appears to be, that's not enough right now, just according to the recent data I got. But let's say 10% vacancy, 32% expense at a 6 cap, assuming the cap rate's the same, that building's worth $14.6 million. I am a builder. They don't have that much in it in development equity. Okay. They're already into the investor equity here at 14.6. I guarantee it. He's probably building somewhere between 7 and 10% margins. So if he's trying to get, originally 20 million or 18 million, he's probably got somewhere around $1.8 million that he can come out of that and eat all his equity out, his sweat equity, if you will, development equity. Maybe a little more. It kind of depends on how you look at it, whether you're looking at net or gross. But I was talking net. But here, what if we go to a 7 cap? $12.5 million. And I told him last fall, when interest rates were quite a bit lower than they were here, I told the broker, I said, well, with all due respect, every time interest rates go up 1%, you lose $1 million, $1.2 million. They didn't grasp that. Okay. And the reason is, let's think about this. When is the last time somebody's actually invested in this market? I don't care if you're doing a 401k, if you're saving in a cookie jar. I don't care if you're saving, if you're buying stocks, mutual funds, bonds, life insurance, real estate, apartments, office, developing, building houses. I don't care what you're doing. You haven't seen an environment like this. In fact, I would say the rate of change in interest rates probably ever in history, but we certainly haven't seen this environment in at least 43 years. So unless we started very young and we're over age 60, the people that have lived through this are absolutely zero. So you wonder, why is the builder in denial here? He's holding on to this, and he'll be able to do it as long as his equity, as long as he's got either enough cash backing himself or his investors have enough cash backing to hold it. And frankly, if they'll hold it, they'll be fine in time. But if they don't, they can only hold it until, as long as the lender keeps patience. When the lender calls the loan, they're in trouble. Okay. Again, deflationary. What's that do to the money supply? That's the point. That's a real deal. So then we get into an article in Forbes. Remember, about 1.5 trillion in commercial real estate debts coming due in the next couple of years. I think by the end of 2025, I think that's a pretty close number. So article in Forbes, Fitch rating agency says the biggest banks only have about 6% of their assets in commercial real estate, but on smaller banks, about 33% of their assets are in commercial real estate. Uh-oh. How many of those are office buildings? How many of those are Silicon Valley banks? Okay. So then a Yahoo Finance article, this is how you can start to read the tea leaves if you understand the mechanics and the internal plumbing of the system that we just went over. You see Warren Buffett is selling bank interests he's owned for more than 25 years. April 12th, Buffett says banks go bust, but depositors aren't going to be hurt. You know, I disagree with that. No, I see what he's saying, but I don't want to go down that rabbit hole. It's going to land on the taxpayers. We're not over bank failures, but depositors haven't had a crisis. Buffett also said in part, quote, I say this is the beginning of the demise of small banks for sure. Charlie Munger, his number two, his sidekick, just came out and said commercial real estate's in for a reckoning. Banks are in for a reckoning with commercial real estate. And it's because of all this office space. And we were talking about this 2 years ago, or no, year and a half ago. They were calling it broken glass back then. In other words, all these vacant office spaces, how long can it go? Okay. Well, now that was when we were in very loose monetary policies. There was just helicopter money everywhere. Well, now it's getting tightened up. The monetary side's becoming deflationary, and that's turning into a problem. So a few other things we can look at. This is what a healthy yield curve should look like. Maybe not that steep, but it's a concept. In other words, anybody can understand this is time, this is rate. So when you hear yield curve, I want to give you a few tools you can look at out there besides just how the money moves around. Let's say this is overnight, and this is 30 years. Logic would say if you were going to loan me $100,000, you might do it at whatever, 3% overnight. But if you wanted to be married to me for 30 years, you got substantially more risk. So you should require a higher interest rate because I could lose my job, I could die, I could do all sorts of things that would default on that loan. So your risk goes up as time gets longer, so your rate should increase as well. This is an upward sloping curve. That's the way yield curves should look. They should go up from left to right. Brian and Brooke, I'm sure would dig into this. I'm sure they have 100 times, but I don't want to dig in too much here. I don't want to lose everybody. I want to look at the black line. This is about a year ago. This was the yield curve right off the Wall Street Journal about a year ago. Notice it is sloping up from left to right until here. Then the 10-year started dipping. This is where you started hearing about an inverted yield curve. We started making videos on that. I don't remember, probably 9-10 months ago, something like that. And we were talking about an inverted yield curve, and that's when the 10-year Treasury dipped below the 2-year Treasury. That has accurately predicted a recession every single time since back to 50s or 60s. I think one might have been a false positive. It still shrunk in GDP, but it didn't actually go negative. So it didn't. So almost 100% accuracy every time. Well, what did the Federal Reserve say? We don't really worry about this anymore. That's outdated. We only worry about it when the front end of the curve gets inverted to this far end of the curve. So in other words, I remember them talking about when the 3-month starts getting inverted to the 10-year, that's when we're going to be concerned, because as they move the overnight Fed funds rate, see, they have a lot of influence on this 1 and 3 month spread. As they move the overnight rate, which means what banks can lend to each other overnight, as they move that up, that should pull this end up, which it did. You can see it here. So they have a lot of effect here. They have very little effect out here. This is all market expectations, okay? So as this comes up, which it did, this should also come up. Remember, it should slope up left to right. And think about that. If you could get 4% back here, why in the world would you take less than that for 10 years? You could get that in 1 month. Why would you? And you could just roll it over and over and over. Why would you do less for 10 years? Well, what this is, and this is why yield curves are important, is this was institutions hedging. They started to see trouble. And when you think of the power of the global monetary system, think about the brain power behind that, the aggregate total of thought that goes into that, the amount of institutions that are moving billions of dollars at a time. They're all thinking and talking to their friends and seeing whatever they're seeing. Tremendous amount of economists and forecasters all goes into a think tank and they make decisions. That's a lot of brain power. Okay. So it's a good indicator of what's coming, what the market's expecting. And remember, the market's based on trust and confidence. So as the market starts to expect something, it can almost become a self-fulfilling prophecy. So what happened here is this should have been pulled up. But again, as people wanted more of them, as this starts coming up, they start bidding on them. Remember, when we bid up the prices, the yields go down. So they're holding the yields down because they're buying these assets. Why would they do that? Well, if they see a commercial real estate problem, or they see a problem in whatever their assets are, say it that way, and they're worried about, we could have economic trouble coming, we could have a recession coming, and our assets could lose value. The way they hedge that is they would come out here and buy some of these. Because if all of a sudden these fall in value, that should pull this down, and now they're sitting on a bond that's paying a higher yield, and they could sell it at capital gain. So they may lose on whatever their other assets are, but they may gain here. Okay, so they're hedging their risk. So yield curves matter. And what they said at the Fed, this is why the mainstream media, if you're following it, you're always behind the curve. They said, behind the 8 ball, they said, hey, we're not worried about when the 2 and the 10-year invert. That's old news. That's only been right every time for 70 years. We're not going to follow that anymore. We're going to worry about when the 3-month inverts with the 10-year. Well, the inversion just kept coming further and further back. And eventually it ends up where we're at now, where you could get 1 month is inverted to the 10-year. Overnight rates, 4.8 to 5%, literally overnight. It doesn't get shorter than overnight. That's as short as it gets. And it's inverted to 30 years. So it's wildly inverted now. Well, then they started saying, we don't worry about that. To take from Gammon, he's absolutely right. If you guys don't follow George Gammon, you should. He's absolutely right. The narrative shifted. And Jeff Snyder, another one, is if you just go back and look at their narrative, it shifted. And they said, we're not worried about the yield curve at all because we got such strong employment. And the narrative just keeps going along. We're not going to have a recession because we got so much strong employment. We can get a soft landing. And then it turned into, we can probably get a soft landing. And now they're saying soft landing is unlikely. And then they've pivoted to, we're probably going to get a recession later this year, but it'll be mild in nature. The market is not pricing something mild. Okay. That's the point. So if you follow my social media, you see me post this stuff sometimes, and you may look at it and say, I have absolutely no idea why he posts that. I don't know what it means. Well, I get it. I watch the bond market every day, and this is a 1-month T-bill. So 4 weeks. This should move very slow. The bond market, see how this line right here for the day is flat? It should be very boring. Bonds are supposed to be boring. They're supposed to move like 2 basis points or something a day. That's 0.02 of a percent. It takes 100 basis points to be 1%. Nothing should happen. And ever since Silicon Valley Bank, we've got into these, and it wasn't just right then. It came for multiple weeks where the bond market would just go crazy. And generally the instability would be in what they call the Eurodollar market, which is the offshore dollar market. That's usually where you see the bumps. And then when the day trading session in the United States opens, it kind of levels out. It's opposite. Look at the opening times, okay? And they're falling. So whatever's happening, there's a lot of stuff happening, or with at least ties domestically, that's causing this stuff to fall. 40 basis points is insane. Okay, and actually this day it hit 52 in 4 hours, 0.5%. Why would the yields be going down? Well, I just explained they have an inversion relationship. A tremendous amount of money is bidding on those 4-week treasury bills. So it's pushing, they're bidding the price up, which is pushing the yield down. Okay, so let's think that through. There's only so many of these in the market. There's only however many the treasury is issued. So they're scarce. They have a scarcity. So if they want them, supply and demand, they start bidding up the price, it pushes the yield down. The question is, and I don't want to get into this too in depth because this will be kind of confusing, I think, for most, but there's a repo facility where banks could go, or institutions with access to the Fed could go. And I would say even institutions that don't have direct accounts with the Fed, but can get there through somebody who does for maybe a little bit of a premium, they can all access it, these big institutions. The Federal Reserve repo facility, reverse repo facility, what that is it's basically a place that say a bank could go, or an institution could go, and they could get 4.8% yield on their bank reserves, or their money, their currency units, overnight, risk-free. It's the only thing 100% risk-free. And the reason I say that is the Federal Reserve is the only bank that can't go bust. If they screw up, they can just create the money on they just literally type in the numbers and fix the problem. So this is as risk-free as it gets. Now, this is very low risk. This is considered a risk-free alternative to cash, but this is literally risk-free. So you got to ask yourself, why? Think of how much money, how much money would be in the bond market to push it down that much. It's a lot, hundreds of billions, maybe $1 trillion. I don't know, a lot. So my question is, look at this. They're not after yield because they're willing to take 3.3% when they could get 4.8%. Why would they want 1.5% less interest on billions and billions of dollars? Well, the answer is simple. They're not after yield. They don't want the yield. See, that's the benefit of understanding the plumbing. You look at what the rest of the public's looking at, all they're looking at is Wall Street. They just look at the stock market. And if you've ever watched any of my videos, I've been beating this drum for a year. If you're looking at the stock market, you're driving a vehicle looking in the rearview mirror. It's just a historical reporting tool. Whatever the causation was, that produces a result, you're just seeing the end result of it in the stock market. The smart money looks at the bond market. This is a barometer. This is an indication of what is coming. Okay, so you start to see how they interconnect. Well, here, what it's saying is a tremendous amount of money. I mean, just unbelievable amount of money in 4 or 5 hours wanted this collateral so bad that they were willing to take 1.5% less than where they could go. And actually, they have a little bit of risk here. We're facing, will the government renew the debt? Well, of course they're going to renew the debt, but it's still a little bit of risk. And if you get it wrong on $1 trillion, that's a problem. Okay. So why are they wanting this when they could have this for less risk? That's because they want the collateral. The best collateral, what would you use collateral for? Well, think of yourself. If you want to get a loan for a car or a house or whatever, the bank's going to say, well, how are you going to pay me back? Well, what's going to happen if you don't pay me back? Well, they're going to make you post collateral. So people want collateral, or they just want super good assets that don't have a lot of long-term exposure, but they want the collateral. Why? Maybe they expect a lending need coming up. Maybe they expect a liquidity shortage, and they want the best collateral to compete for the currency units that are available. See? Because if you think about a 4-week T-bill, how good a collateral that is, it's backed by the U.S. government. And if you've owned it for a week, you only got to wait 3 more weeks, and you don't got to take a haircut by taking it to market value. You just got to get to maturity, and it's only 4 weeks away from the time you get it. That's pretty short term. That's why it's the best collateral, and the global market wants it. When you see this, I highly recommend you watch this. This is abnormal. A big move, for comparison, a big move in the treasury market would be like 6 basis points in a day. You'd be like, well, something's going on there. 20 basis points. Oh my goodness, there's an all-out collateral rush. Who's rushing for collateral? You see 40, 50 basis points, 60, 70. That's nuts. And I can't remember exactly, but that's on par or bigger than 9/11. That's on par or bigger than the GFC. I mean, when you start seeing these swings, 100 basis points in a day, that is not a sign of health. Okay, guys, that's something's broke. Okay. So anyway, I wanted to share that with you so you could kind of maybe look at that through a different lens. And that's why I post those all the time. So now I want to talk about the discount window. And I try to think about how I could keep this simple. Let me first read this. This is from 24th of March, talking about banks going to the discount window, $117 billion each night. That was up $32 billion from the week prior and surpassed the average of the $112 billion in the financial crisis. So this is back to 08. So they're going to the discount window more than they were in 08. Of course, I look at that. I'd be curious Brian's opinion, but that might be a little bit of fake news because I think you might want to do some inflation adjusted numbers there. I mean, today numbers aren't the same as then. So that might be a little overstated, but still it's huge. It's wildly huge. So I want to think, how could the average person understand the discount window? Well, there's a stigma with it. Banks don't like to go there. See, that's why this is flat. See how much time goes by. Nobody goes to the discount window. Then we have the illness, and then, oh, I want to get out of there, and I want a good image, and then, this is the financial crisis. That's why it's so flat. Nobody wants to use it. There's a negative stigma to it. Think about it this way. If you're somebody selling financial instruments, you're me, I'm putting out investments, and you see me down at the pawn shop selling my used watch and my rifle and, my Nintendo games, and I'm just trying to get out of there for $15. How good do you feel about doing business with me? Not very good. There's a stigma to it. Well, banks are the same way. It kind of has that type of stigma. If they're going there to borrow from the Fed, they're saying, "Oh, we got a liquidity problem." Well, how apt is somebody to want to do business with them? So nobody wants to go there. And now all of a sudden, tons of people are going there. Okay, that's something you could be watching is the discount window. And there's all sorts of other things. I didn't put them in here in the interest of time. You could be looking at interest rate swaps and all these derivatives they do to hedge their balance sheets and everything, hedge their risk, if you will. And maybe Brian will have some dialogue about that at the end here when we go to just open conversation. But there's a number of pieces of anecdotal information out there that may not mean a lot. That cell phone data report didn't mean a lot in isolation, but when you put it in context to everything else, it starts to add up. And once you start to see the plumbing and the way it works, even if you didn't grasp all this tonight, once you understand some of the way it works, you get to see the news differently. That helps you get out of the way of problems, and it also helps you capitalize on opportunity. So many banks' balance sheets are in pain. Deposits are drawing down. Why? Well, deposits went way up during the illness because they just gave everybody money. Remember, when deposits are up, they can use that money to lend. Deposits are shrinking. That's been running off for a period of time. And there's a number of other reasons too, not just stimulus runoff. But now banks are having to compete for your dollars. I'm sure everybody on this call has thought, why do I got my money in a bank at 0.25% when I could go to UStreasury.gov, open a treasury account, and buy my own T-bills, 4-week yield or 4-week maturity dates. Remember, we just talked about big institutions use that to hold cash. You could go there and buy them at 5%. So now banks, they're losing deposits. So now they're trying to bring up the yields on their deposits, the interest rates they pay, but that's an expense to them. So their expenses are going up. At the same time, their assets are struggling to perform. Remember all the commercial real estate and so forth. That means their revenue is going down as their expenses are going up. Not a good situation to be in. So what can you do? Well, we talked about you could look at, I don't know what your banking situation is, but you could look, are you within the FDIC limits? You could check the health of your bank. The banks publicly report their balance sheets. You could see how solvent they are, how leveraged they are. George Gammon had a great point when my buddy Robert Helms was interviewing him on the Real Estate Guys the other day, and I just thought I would share it. If you don't know how to do anything else, he said one thing he would be cautious of is just going to the bank that's willing to pay you more, because what they're really saying is they need your deposits. You might be better off with the bank that doesn't pay as high because they don't need your deposits as bad. Okay, so that's a pretty surface level analysis, but you can get the documents there. Just search them on the internet. You can see the health of your bank. You could buy T-bills. You could go into money market funds. You could do a number of things. There's other things you could do. Now, I don't want to sound all doom and gloom because there's opportunity out there. Not everything's a problem. The flip side of every problem is opportunity. Well, there's about to be a whole lot of assets come on the market unless something changes. I should say probabilities are a lot of assets, distressed assets hitting the market that should perform well, or I'm sorry, that you could buy maybe to discount and repurpose, or all these people are moving to other areas. That's what's causing a lot of the stress on the assets. Where are those areas at? Just not because it's not going to be a recession everywhere. Some areas will win, some areas will lose when it comes to real estate. So finding out where those people are going and getting in that path of progress. Okay, there's a number of things you could do. One thing we're doing, just to illustrate, I usually don't put anything we're doing on here. Usually this is just for information. But one thing we're doing, and if you want information about it, you can send an email to atm@code3assets.com. But I've come to like that asset class, and you can get the information on there. Is anybody that's ever talked to me about it knows we're not buying a few ATMs, putting in a gas station. It's huge portfolios of them. But the reason I like it is they've been shown to work well, and they're recession resistant. They performed well in the last couple of big recessions, performed well when the economies were locked down. What I like about them, and I'm just sharing the analysis, not the asset, because I don't care what you do. You can go do anything on your own. I'm not saying you have to do this with us. That's not the point. What I'm trying to illustrate is the thought behind it. What I like is it's not tied to the credit markets. It's not tied to the bond markets, all that. It's not tied to the banks. It's not tied to cap rates. It's not tied to loan to values. It's not tied to migration out of those places with commercial real estate. Okay. That's why I like it. Now, you just got to do risk gain analysis on it, SWOT analysis on strengths, weaknesses, opportunities, and threats. You got to do that on anything you do. But what I like is I'm unplugging from the debt markets, the credit markets, the stock market, all that. So, and I'll just share one thing, and I haven't lived through this, but one thing I am following is if you watch, the 2-year and the 10-year are coming back down. Okay, so this delta is narrowing. Watch this. And what a lot of the experts I follow are saying is historically, when the 2-year drops below the 10-year and this curve steepens out, goes back to looking more like this, that's when the proverbial stuff hits the fan. Okay, so that's an indicator you could maybe watch for. And they say that a lot of times what will happen is the Fed will start to pivot. Historically, I'm speaking, the Fed will start to pivot, start dropping rates, lights on Wall Street go green, everybody gets excited, starts buying, and then it's kind of like a pump fake. Now we got a slowing economy, we got slower corporate earnings, we got insecurity, instability, and all of a sudden people just get the rug pulled out from underneath of them. They said historically, I follow a lot of folks that I'm sure Brian and Brooke follow as well, but that's something I'm really paying attention to. So anyway, a number of things you can do there. I didn't go into the mission as far as why I'm doing what I'm doing, why I put this much time. It's about 15 hours of work, 15 to 18 hours work go into every one of these. It's really not about the assets to me or selling investments. It's a mission to me. And we didn't have time to go over that tonight. But if you send an email to nextlevel@code3assets.com, I'll give you a free digital copy of that book. I was asked by Kyle Wilson to be a part of that book and wrote a chapter in there. That was beyond my typical comfort zone, but I tell the story as to why I'm doing what I'm doing in there, at least as much as I could tell in 2,500 words. So send that email. We're happy to have you do that. And we'll shut off the recording here and we'll see if we got some, I'm sure Brian or somebody's got something to say.